Hello everyone, I'm Noah Lui, Head of Investors Advisory of RHB Bank. It is again our Money Chat series to talk about the outlook for year 2024. In our recent videos, we have discussed in length about the prospect in global equity, including the lack of technology and artificial intelligence. Please scan the QR code below if you wish to revisit some of the recent videos. Today we have three esteemed speakers who will be sharing their view on the flip side of the world, mainly focusing on emerging market. Mr. Toon, Chief Investment Officer of RHB Asset Management Singapore. Encik Muhammad Fauzi bin Muhammad Tahir, CIO of RHB Bank Malaysia, will share his view on domestic market. And finally, Mr. Michael Chang, CIO Fixed Income of RHB Bank Malaysia, who will share his insight of fixed income. With the prospect of rate cut materializing sooner or later in 2024, futures market has priced in that rate cut may happen as early as Q1 in 2024. Let's hear from our speaker today if assets within their field of expertise deserve more attention in the year of 2024. As far as 8 December, most of the major market covered by us has been on the uptrend, with Nasdaq at the moment close to 40% above where it started this year, thanks to generative AI. Meanwhile, China market such as CSI index was down by 30% in the same period, which means the difference between these two markets are more than 50%. Jiten, thank you very much for joining us today. China market is down for the third consecutive year. However, with the broad market may experience stability as we see the end of the rate hike cycle, do you see China market rebound in 2024? And can you share the three key reasons to support your views?
Our view is that the Chinese equity market will rebound in 2024. There are three main reasons why we think this will be so. The first one is that the government policies are starting to turn pro-growth over the course of the last 12 months or so. The Chinese internet sector, for example, that was under the pressure of regulatory tightening. We have seen the end of this regulatory scrutiny, and in fact, policies have started to loosen considerably. And in terms of the Chinese property market, we are starting to see very restrictive policies that has been tightened over the course of the past 6 years or so, starting to loosen over the course of the last 18 months. Last but not least, in terms of the fiscal policy, the very surprise mid-cycle fine-tuning of the fiscal budget to support growth has been welcomed by the market over the last few months. The second key point is that the Chinese property market, in our view, are starting to bottom out and in fact stabilizing. The secondary property volume are starting to recover, albeit from a very low base. The government policies have been very supportive, and they have been targeted at home buyers in terms of easing home buyer restriction, as well as to support property developers. Last but not least, in terms of valuations, I think the Chinese equity market valuation is indeed very supportive. Currently, the Chinese equity market is trading at less than 10 times after the drawdown that we saw over the course of the last 3 years. Earnings recovery are starting to come in very nicely in 2024, and that will be very supportive of stock prices. Last but not least, I think the valuation of Chinese equity market is cheap versus its own history, as well as versus other markets, including the developed markets. So these are the three main points why we think that the Chinese property market will start to rebound by 2024.
Jiten, thank you very much for your sharing about the three reasons to invest in China. As we have heard about the broad market view, as a fund manager is also responsible to pick the underlying or sector that is believed to offer excess return to investors. Please share with our investor your three most preferred sectors and three least preferred sectors in 2024.
The three sectors that we are most positive on will be the following. The first one would be the REITs sector. In our view, we have seen the end of the aggressive interest rate hikes in 2023, and in fact in 2024, we will start to see interest rate cuts. And in this kind of environment, I think REITs will tend to benefit with interest rates getting cut in 2024. The other sector that we are very positive on would be the technology sector. Our view is that the technology sector, especially the semiconductor sector, has started to recover over the course of the last few weeks, and that will extend into 2024. And the entire sector is also well supported by AI or artificial intelligence plays. So in our view, I think with semiconductor recovery as well as artificial intelligence, I think technology sector will be well positioned in 2024. Last but not least, we are also very positive on the energy sector. Our view is that the energy prices will be well supported by the ongoing geopolitical tensions that we see all around the world. And on top of that, in the oil sector, we are starting to see the impact from the underinvestments that has taken place over the last few years due to the COVID crisis as well as ESG considerations. And the three sectors that we are most negative on would be, firstly, the banking sector. As what we mentioned earlier, our view is that we have seen the end of the interest rate hikes and we will start to see cuts in 2024. And in that kind of environment, I think the banking sector will tend to face headwinds due to NIM's pressure. And the other sector that we are negative on will be the material sector. I think we will start to see weaker growth in the developed markets in 2024, and that will have implications on the demand of materials as well as commodities. And last but not least, we are also concerned about the consumer sector. Our view is that the weaker consumption trends from weaker consumer sentiments due to the slowing economy in the developed markets in particular will have a negative impact on the consumer sector in general. So these are our reasons on why we are positive and why we are negative on the sectors that we mentioned earlier.
Ethan, you have shared about your view on your positivity for China and also the sectors that you think that will benefit in 2024. As there is increasing talk about China plus one, which is also means investors seeking for alternative out of China. For this investor, is there any country or region within emerging market that you are optimistic on?
I think the first country that comes to mind will be India. I think India is very, very well positioned to benefit from this multipolar world. I think India's economy and equity markets in general will tend to perform well in a situation where people are trying to find alternatives to China. And not only that, I think India over the course of the last few years has shown the strongest post-COVID recovery in the region. And in 2024, we expect earnings outlook to be strong, especially with the good domestic credit expansion that we see over the course of the last few quarters. And I think in 2024, India will stand out as the fastest growing major economy in Asia. And on top of that, the two countries that we are very positive on would be Korea and Taiwan due to the recovery in the technology sector. Our view is that the technology sector has passed the memory price trough in the second half of 2023, and I think the memory cycle will find support with demand recovering over the course of the next few quarters, and also demand will start to broaden out as well. And the supply discipline that we see in the sector was will continue, and that will lead to better inventory digestion, and that will be supportive of semiconductors prices in general. And not only that, I think the technology sector will be well supported by artificial intelligence or AI plays. I think this is a key structural growth area, and I think Korea and Taiwan are well positioned to benefit from these trends. We are also starting to see evidence of broader application as well as monetization of actual AI application over the coming few quarters. And that will definitely provide well-needed support for the technology sector as well as for Korea and Taiwan.
Thank you very much for investors that joining us today. From the Lipper Investment Manager data that we collect, we have observed there are some outflow from the Chinese equity market within the Malaysia unit trust industry. If you have any question or concern related to China, please put in the comment box below so that Toon can address them. This is my last question, Toon. I just want to tap a bit on your expertise when it comes to some global issues, or should I say concern. Do you see the prolonged Middle East tension weigh on the global equity growth? Anything that investors should watch out for?
I think the Middle East tension is indeed very unfortunate. I think the most direct impact from the Middle East tension will be on the oil prices. And at this current juncture, I think oil prices are still relatively well behaved. And in fact, oil prices are in fact trading below where it was during the peak of the recent Middle East tension. So our view is that from a global perspective, I think most investors are relatively comfortable despite the escalation that we saw in the Middle East over the course of the last few months. And the other important point I want to highlight is that the secondary impact from the Middle East tension would be on the equity risk premium in general. But as you can see from the equity markets, since October, we have seen a very, very nice run-up in the equity markets over the course of the last few weeks. So from that perspective, I think in general, I think investors are still comfortable taking risk in the market despite what we see in the Middle East. However, we do need to watch out for the spillover impact, which I think is the most important part. I think we need to watch out to see if the Middle East tension will spread and will Hamas gets involved, or will other countries like Iran get more involved in the entire conflict. And also, we will need to watch out for the response from the rest of the Middle East countries as well. So this is important on the perspective that it will have an impact on the oil prices, and the risk of a higher oil price is that it will obviously impact inflation all around the world, and as a result, it will also have implication in terms of the interest rate trends that we will see in 2024.
Moving from global market to domestic market, we have Encik Mohd Fauzi joining us. Hi Fauzi, Malaysia equity market has been relatively unloved recently, with us seeing low foreign investor participation in our market. KLCI has been a disappointment in 2023. What are the areas or sectors where you see a fund manager could create excess return from local equity market next year? What is your view on ringgit prospect in 2024?
Okay, thanks, Nova. I think let me answer in two parts. The first one is the performance of the KLCI in the first half of 2023. The KLCI performance was weak actually in the first half of 2023. From the chart, the CI was the second worst performing market, down by almost 8%, only better than Thailand, which was down by almost 10%. There are a few factors contributed to the weak performance. The first one is weak currency. Ringgit declined by about 5.65% from the end of 2022 to 30th June 2023, mainly due to the interest rate differential between Malaysia and US. The second reason was due to the foreign institutions, which were the major seller, and they have net sold of about 4.192 billion of Malaysian equities. They have been persistently selling Malaysian equities in the first half of 2023. The third point, I think, was the impending state election in August. And the last but not least is the external uncertainties over US economy going into hard or soft landing as a result of the aggressive rate hikes taken by the US Federal Reserve. But I think the performance of the KLCI has rebounded quite strongly from July onwards until 30th November 2023. From the chart, what we can see, the index has rebounded from July. KLCI is the second best performing market from July until November 2023. Among factors contributed to the rebound was the foreign institutions, which has turned net buy from July onwards with 1.7 billion inflows. With the expectations that US dollar is likely to weaken. And then also there is an expectations of a soft landing in US where inflation stabilizes without economic growth taking a significant downturn for the US, which means that the recession would likely be avoided. And also the last but not least, I think the structural reforms which was announced by the government from July onwards, that has contributed to the positive performance of the KLCI. And also I think the expectations that the US interest rate might come to the end, so that also actually contributed to the better performance of KLCI of KLCI in the second half of 2023. However, year to date, KLCI is still down by about 2.9%. Having said that, Malaysia, the CI which was down by 2.9%, but we are still the second best performing market in ASEAN. So going forward, in the absence of strong catalysts to push earnings growth for Malaysian corporates, we are of the opinion that liquidity will be the main market driver in the short term. Should US achieve soft landing, commodity-based country like Malaysia would benefit and would also have ringgit to recover, and also this will drive actually the inflows into Malaysia. Broad market should benefit, in particular healthcare, constructions, building materials, and utility sectors.
Post C Biden meeting in APEC, we have yet to see material improvement in the US-China relationship. Malaysia appeared to be relatively neutral when choosing its side. Is there any material benefit that Malaysia enjoy from this ongoing US-China tension scenario?
Right, thank you. What we think, both China and the US major trade partners actually for Malaysia, with a trade shares of 17.1% and 9.4% respectively in 2022. Key exports to these countries are the E&E products, LNG, palm oil products, and also petroleum products. So the trade tension between these two major countries has resulted in trade diversions actually to other countries, of which Malaysia is seen as a key beneficiary. The benefit is likely more due to the US tariff on China as opposed to China's tariff on the US, given that China is more of a manufacturing hub for multinational companies than the US actually. So sectors like glove, technology, the electronic manufacturing services, and also plastic actually would benefit from the trade diversion.
Malaysian government has been clearly embarking on the subsidy rationalization path. However, this needs to be carefully done in order to balance out the potential negative impact to the society's affordability. Do you see inflation a big concern in Malaysia? And how would the government tackle the inflation issue?
All right, thank you. I think we can see from the chart, and Malaysia inflation has been trending down actually. Currently, inflation rate has slowed to less than 2% since September 2023. The headline inflation dropped to 1.8% from a year ago compared with September of 1.9%. And core inflation also down 2.4% year-on-year compared with September of 2.5%. In particular, food inflation was at 3.6% in October, the lowest since January 2022. Other components in the CPI basket are also improving. Service inflation dropped to 2.4% year-on-year from the peak seen in December 2022. Durable goods inflation has been declining in similar fashion as well, down to 1.2% year-on-year in October. But I think, like you mentioned just now, there is an also upside risk actually to inflation rate next year, mainly due to further subsidy rationalization, specifically targeted fuel, which is diesel and also RON 95. This subsidy rationalization as it will be rolled out in the second half of 2024 after the targeted electricity subsidy and also the end of the chicken price subsidy this year. So current subsidized prices of RON 95 is 2.045 per liter, and diesel is about 2.15 per liter. This was set back actually in February 2021 when the crude oil price was around 60 to 65 US dollar per barrel. Against currently, I think it's about 75 to 80 dollars per barrel. So it is estimated that every 10 cent per liter adjustment in fuel prices will raise inflation rate by about 0.3% percentage point actually. So we do not think inflation will be a major concern, as the consensus is looking at marginal increase only in the inflation numbers in 2024. If expected to around 3% in 2024 compared with about 2.6% in 2023. So I think to manage the inflation impact of fuel subsidy rationalization, we would expect the government actually to focus on strict enforcement to address serious leakage in diesel subsidy, estimated as much as about 10 billion against total annual diesel subsidy cost of about 18 billion. So without the need to raise actually any diesel price going forward. And also the other thing what we think the government might do to manage the inflation impact is to mitigate cost of living on fuel subsidy for the lower income via gradual adjustment in fuel prices, and also additional cash assistance, redistributing part of fuel subsidies savings. And the last one, what we think the government might do is through progressive wage policy alongside the subsidy changes. The economy ministry will present the progressive wage policy to Parliament, addressing low wages in Malaysia and also emphasizing the need for productivity-driven wage growth through upskilling actually efforts. Thank you.
Thank you very much for sharing today, Fauzi. I'm sure a lot of investors that is not willing to take foreign equity market risk would love to hear from your insight about Malaysian domestic market. We'll quickly move on to our next speaker. Here is our last speaker, Mr. Michael Chang, CIO of Fixed Income RHB Asset Management Malaysia. Michael, thank you very much for joining us today. For the past 1 year, we have gained some interest from our investors investing into fixed income funds. In fact, there is also a lot of interest on retail bond with some yielding between 6 to 7% return. However, I noticed that our investors are more interested on Malaysian fixed income instead. Given the house view for 2024, how would you rank your preference between global, Asia, and Malaysian fixed income market? And please share the supporting points of your view.
Thanks, Nova. I think that's a great question. So between Asia, global, and Malaysia, I think we have to look at what's the backdrop. The general backdrop for global interest rate has been a story of divergence between developed markets and also Asian markets. In the past couple of years, we actually see the Western economies adopted a more hawkish approach towards interest rates because they were actually tackling exacerbated inflation, and they have raised interest rates to multi-decade highs, which actually is unprecedented. For the Asian economies, on the other hand, they have actually taken a more cautious approach towards raising interest rates, and same goes for Malaysia. We have actually seen a more consistent approach in increasing interest rate to address on inflation. So I think the chances of US over tightening is there compared to Malaysia. In terms of returns, I agree with you in the sense that some investors actually do prefer Malaysian bonds because global bonds has actually, in a way, has more room to rally, but at the same time, they are also assuming more volatility and risks. While these big moves have somewhat affected Malaysia to a certain extent, but Malaysia exhibited a more stable performance in terms of its bond returns and actually maybe a bit more appealing on a risk-adjusted basis. Just to give you a context of how much global bonds has rallied versus Malaysia, global bond is on track to actually deliver a return of around 5% in 2023, given the volatility that we have seen in the whole global bond market in 2023. But on Malaysia, on the other hand, is actually on a more favorable note because it's actually on track to return 6+% in 2023. So on that basis, if you're talking about risk-adjusted returns, lesser volatility, there's actually a attraction in the Malaysian bonds that has actually kept investors happy with these returns.
We're talking about the prospect for fixed income. Well, we can't shy away from talking about the interest rate hike cycle. Considering that Malaysia has not hiked interest rate aggressively like US, does it mean also that when US cut interest rate, we may not cut as fast as US do?
Okay, this is a great question to start off for 2024. I think we believe Malaysia's interest rate cycle have actually come to a period of stability in line with the inflation numbers that we're seeing currently. I think in terms of inflation, year on year, Malaysia is actually going to go below 2%. I think October's numbers were about plus 1.8%. September's number was plus 1.9%. So we actually see a trend of declining inflation for the country. And Malaysia is expected to reach a GDP close to 4% by end 2023. So going into 2024, I think the outlook for interest rates will be highly dependent on the growth forecast, balanced against the fiscal policy changes that the government is currently proceeding, including the targeted fuel subsidies planned for 2024. But having said that, our base case is for this target rationalization to be rolled out on a gradual basis and to keep inflation relatively in check. Therefore, I think with this backdrop, we are of the view that BNM or Bank Negara Malaysia will keep interest rates, overnight policy rate unchanged, 3% throughout 2024 to ensure that this rate is supportive of growth. It is unlikely that OPR will be cut unless there's significant downward shift in the domestic growth, a surprise unemployment number. If all these were to come, then actually then there's capacity for OPR to be cut. But I think in any case, the Western economies will lead this round of cut rather than the Asian or Malaysian market.
Besides corporate bond, I also observed there is a lot of inquiry from our investor wanting to lock in yield in the safer assets such as the US Treasuries and Malaysia government securities. However, price has moved up in the recent months. Do you think it's still worthwhile to consider now? If yes, what type of duration investors should look into?
Thanks for the question, Nova. I think this is a great question to start off also for 2024. It's going to be an exciting 2024 because, in terms of, we've seen how rates hikes have been happening in 2022, 2023. I think overall, we're still bullish on MGS and US Treasury markets, given our outlook of more benign interest rates. And this is likely to be an environment for 2024. And this is on the backdrop of also moderating inflation. In the past, the end of a rate hiking cycle usually coincides with a peak in government bond yields. And when yields taper from its high, I think bonds do make good returns. So in terms of duration, we would actually advise yourself or clients to actually look at a more neutral to longer duration as you position for 2024 to maximize potential returns on the view that possibly there's a resurgence of a cut interest rates globally, but likely this will be spearheaded by the US and the more Western economies. So between the two securities, in terms of Malaysia and US Treasury, and if the concern is on volatility, correlation for MGS and US Treasury has also eased significantly over a period of 10 years, with correlation now reading at about 0.11 to a high of 0.37 in year 2020 in the year of pandemic. So what it means is that if there are excessive moves in US Treasuries, it is unlikely to do the similar impact and backlash to Malaysian government securities. In fact, I think the Malaysian government securities market is driven more by onshore supply and demand dynamics and investors, in terms of comfort on the interest rate outlook and also inflation. But there are, of course, also other segments within fixed income that investors can look at besides MGS and US Treasury. If they are comfortable with credit, they can also look into corporate bonds because corporate bonds also provide a higher yield than Malaysian government securities. And they are also set to benefit on the outlook on bonds for the whole of 2024. But then, of course, if you're investing in corporate bonds, then investors will have to evaluate and assess the individual credit risk of these issuers to ensure that they have a decent return in terms of bonds.
This is my last question, Michael. It's relating to sustainable investing. What is your view on ESG versus non-ESG bond in Malaysia market? For investors who buy this paper directly and hold till maturity, is there any concern for holding onto a non-ESG bond?
Okay, so in terms of the ESG and non-ESG bond in Malaysia, the Malaysian market for ESG bond and sukuk has actually seen a strong traction, evidenced by the country's 27% share of the total issuance of the ASEAN Green, Social and Sustainable Bond and sukuk so far. So regulators, particularly the Securities Commission, has played a very important role and made good progress on this front, providing the needed clarity and framework to facilitate ESG growth within Malaysia and also the bond market. In response to this clarity, I think many issuers are tapping into the ESG space, providing further market depth in terms of issuances and also diversity. So for investors who are currently holding non-ESG bonds versus those that are holding ESG bonds, there's actually no immediate concern if investors are able to gauge the degree of ESG risk in a particular bond. I think that's where the in-house proprietary ESG methodology matters, because as a bond issuer, it needs to be rated, it needs to be assessed also in terms of quantifiable ESG compliance, ESG risks. So even though ESG bonds are labeled ESG, we also assess them so that they meet the appropriate ESG standards. So what it means is that although there will be labels such as ESG and non-ESG, I think we have to do our homework to ensure that we know what we are buying into, and we assess on their ESG degree of ESG by rating them, whether they are on the low side, medium side, or high ESG risk. Of course, those bonds that are rated high on ESG risk, which means that they are, they are primarily in the coal-fired power plants or the more sensitive sectors to the environment, then they would actually have lower valuations and lower liquidity, because investors' interest would definitely prefer bonds that would stand out with high ESG compliance and also low ESG risk. So the part on the premium, it depends on bond to bond. Premium is actually a yield premium, whether an issuer can go into a market with a lower yield as compared to paying a full price for non-ESG, where they have to pay a higher yield to borrow from the market. So typically, this premium, it depends on whether the issuer is really walking its talk in terms of its ESG, and if they do so, then definitely they will gain further traction from the market compared to a non-ESG bond. But all in, I think in short, we need to assess how much of ESG risk is in a particular bond, whether it is ESG or non-ESG. Hope that answers the question, Ranova.
Thank you for your sharing today, Michael. I trust your insight is a strong boost of confidence for our investor navigating in the fixed income market. We shall hear again from you next time. Thank you very much to all our speakers today. Investment is a continuous process. RHB Bank has been frequently producing money chat and podcast series, which you can access to get better insight of our investment view from RHB Merge website. If you have any further questions, please talk to our RHB Bank's Premier Relationship Manager to discuss how your investment portfolio can be positioned to meet your financial goal. See you again in our next Money Chat series.